welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. Welcome back. It's Tuesday, and I'm Barry Saywitz, president of the Saywitz Company, managing partner of Saywitz Properties, and we're glad to have you back here talking a little more real estate. Before we get going, a couple of shout-outs. Number one, a shout-out to the Dodgers, who are going to the World Series again to play the Yankees. That'll be an exciting series, and we're all looking forward to that and hoping for a win for the Dodger Blue. Second shout-out I want to make sure that the people that are out there that are listening are aware that we're still having the Evening for Autism charity event at my home in Newport Beach to benefit Autism and Easter Seals, which is the largest provider of services to children and adults in Southern California that are suffering with autism. Please go to the website, www.eveningforautismsocal.com. There are still tickets available. We have an exciting evening planned, and we'll hope to see you there. So with all of that said, I want to welcome our guest, Shane Shafer, Managing Director of NorthMarq Multifamily. Shane, welcome to the show.
Thank you. It's great to be here. I'm a big fan of the show, and I think you're doing a great thing every week with the shows.
Thanks. I'll give you that $5 later for that plug. I appreciate that. But you and I go way back, and you have held a bunch of positions with several different prominent companies in the multifamily commercial real estate brokerage business, and so I'm excited to have you on the show and share your thoughts on the market and what's going on. Before we do that, I want to rewind and take a step back because I want to talk about how you got to where you are today. So if we go back to the beginning or close to it, you go to Arizona State, you get a degree in political science, which is right in with commercial real estate.
Right.
And you get out of school, and then number one, what made you decide to settle in Orange County? And then number two, what made you decide to get into the real estate business?
Yeah, I graduated, and what I wanted to do was go to law school. That was what I was going to do when I graduated. And I remember at dinner, my dad said, "What are you going to do?" I said, "I want to go to law school." He goes, "Great. You can pay for it." And I said, "Okay, looks like I'm going to have to probably get a job," because back in those days when you played football, there was no NIL deals. You couldn't work. So I literally came out with $1 in my savings account. That's how much money I had, a whopping $1, which was my parents' dollar just to keep the account.
You had 50 cents more than me.
Yeah. So I was like, okay, I got to get a job. So one day this guy came in. My dad was the general sales manager at Galpin Ford, and this guy came in that my dad was doing the deal with to sell the car. And he saw my picture and he said, "Hey, is that your son?" And my dad goes, "Yeah, he's looking for a job. You guys hiring?" And he goes, "Sure." So I interviewed a few days later with a guy named John Caron. And John and I hit it off really well. He said, "Hey, you're going to be great in this business, but I have two locations, Long Beach and Newport Beach. Which one do you want?" That was a very simple decision, right. Newport Beach, and I chose Newport Beach. So I started at Marcus & Millichap, and I remember the first day they gave you like an orientation book, and it talked about like overcoming objections and the different product types, and apartments was the first tab. And I just read the first tab, and I'm like, okay, this is what I want to do. I don't even need to read the other tabs. And that's where I started my career. And back then, if you remember, it was really super brokers, big brokers. It wasn't really about teams back then. And I thought that would be a little bit better route to go, to build a team and build a leverage through multiple folks to try to cover more market. And that's what I created at Marcus. It was a very successful plan with my senior. And that got the attention of another gentleman named Rand Sperry. And Rand Sperry came to me and said, "Hey, look, we've had some shakeup in our apartment division. I want you to help build it out." And I said, "Great, this is a great opportunity." And I have a ton of respect for Rand, not only as a businessman, but as a father and as a husband. He's just a really great guy.
And he's been on the show.
Yeah,
he's very successful and
just a phenomenal individual. And I built out that program, but very similar to what I was doing at Marcus on a larger scale at Sperry. And at Sperry, that's where I really made the change in my business plan from selling 12 and 14 unit deals into larger institutional deals, because I found that there was an area of disruption that we could fill as a little bit better service than what was being done there. And that's where I really made that transition at that point in my career. And we built out that platform very well. And that led to another gentleman that came and said, "Hey, I want you to build out what you're doing there over here. And that was a guy named Don Hendricks. And Don Hendricks had a company called Hendricks and Partners at the time, and they were the gold standard for institutional real estate. And if I was going to do and try to accomplish what I wanted to in this business, that was going to be the best company to be able to do that with. And he gave me a great opportunity, and that was successful. I was their youngest partner to become partner in the company's history. And we did very well. So much so that Berkadia came in and bought us out. And if you remember at that time, there was a transition in the business where debt and equity were teaming up with investment sales groups. CB was the first one to do it. Then you had HFF and JLL that did it right afterwards.
And pretty much at that point in time, too, everybody went to this team approach. There was no, I'm the single guy flying around.
Correct. And so to be competitive in that space, you really had to have a fully integrated firm that could provide the debt and the equity as well as the investment sales. And I was in that integration of Berkadia and Hendricks and Partners, and we successfully accomplished that. And then I got a call from a guy named Trevor Kosovich, who I actually worked with at Sperry Van Ness, and he said, hey, we want to build out the same platform, but on a much larger scale, with really just Southern California. I need you to help me build this out. And I thought it was really an interesting opportunity. I'm very entrepreneurial by spirit. And that's how I went to NorthMarq, and from there we built out the different offices. I opened the San Diego office, the Irvine office, and the LA office, and our goal was really to be a top 5 broker of volume in the institutional space within our first 5 years. We were able to accomplish that in the first 3.
That's awesome.
Yeah.
And so today, NorthMarq has how many offices total?
About 22 across the country, every major market, and we're leaders in, let's say, like the Texas, I think we're top 3, Arizona we're top 3, Orange County we're top 3, so we're competing against much larger firms with larger budgets, and I think our platform and the value representation, the value creation that we allow for our clients really allows us to be a little bit more of a disruptor and be able to provide better service.
And the game plan today in terms of the business model, is it still that small to middle-size apartment building in the local markets combined with the larger institutional deals that come along?
Correct. So once we had the institutional platform up, it was really about undergirding that with the private capital space. So that's our next stage, call it NorthMarq 2.0, is to build out that to be competitive with Marcus Millichap and some of the local regionals like Morgan Skandarian and Tricor and those to be able to compete with those.
And so you have all of this going on. You have the business model. You've done it multiple times before, and you've done it in markets that have been hot and then markets not so hot. It's the recession or trying to make deals during COVID, and then interest rates go up and whack the volume and people rethink it. So if we fast forward to today's market, you had prices run up during COVID, you had still low interest rates, you had stuff selling, even though there was all kinds of other issues with the economy. And then the interest rates go up, and nothing, in my opinion, really happened to the cap rates. They moved a little bit, but not particularly that much. And then you have this inverted curve between the interest rate and the cap rate, where the interest rate is higher than the cap rate, and the returns, especially in Southern California, are just ridiculously low relative to other parts of the country. And so I guess I'm curious what you make of the market in a general sense, and then where you see it going moving forward.
Yeah, it's been a pretty big roller coaster the last few years, and I think we're in a very comfortable space. And I think we're in a new normal. When you look at debt back pre-COVID at 3.5, and in some cases was even sub 3, that's not a normal market, right? And then you look at COVID, and there's so much volatility in that market, and it's almost freezing the capital markets to where transactions can't occur. I remember we had deals in escrow where we went into escrow, and 30 days later when we were ready to remove, the interest rate was 80 basis points higher, and the deal just got crushed. So that was an unusual market. So I think what people were looking for in order to transact was a market that felt like they had some sense of price discovery and some sense of direction. And I think that's where we are at right now. Now, with cap rates being inverted, or with the cost of debt, it really depends on what you're trying to achieve in that deal in the different sizes of deals, right? Larger institutional deals, those deals there's such an abundance of capital for larger transactions today that they're willing to bet on certain markets. They're willing to assume that they're going to get the rent growth, but that's going to be for newer vintage deals, really within the 15-year window that's outside of the 1482 rent control. More vintage deals, people are taking a longer approach. That's how they're getting those deals done, where you can't go in and move rents as aggressively and as quickly because you have restrictions. So you have to have something give there, and that give is price and initial cash flow. Deals are being done differently today than they have been the last few years, and people are willing to take gambles on our market because when you look at the track record through that tumultuous time, people got burned out of state. And they want to balance those portfolios now with some riskier deals, let's say in Arizona or Texas, with some more conservative, steady expected returns here locally.
And so the interesting thing is we've had other guys on the show, and they talk about all the problems, particularly in Los Angeles County and Los Angeles City with all the restrictions, all the governmental controls, eviction restrictions, rent controls, you name it. There's a lot of challenges and difficult hurdles to get over to own a multifamily property in Southern California and Los Angeles in particular. And then I asked them all, okay, so why don't you just sell it and go to Texas or something? And then they're like, no, I'm not going to do it. Right? It's catch-22. Like people, you want to own stuff in California. Also, I think if you're in it for the long haul, the value of the property, I think, is going to go up over time.
Yeah.
The issue becomes the guy who was going to buy 8 units and then flip it and get 16 units and then flip it and get 25 units. It seems like that process has gotten whacked, at least for the moment. And then you still have a differential, I think, in terms of expectation between seller's number they have in their head, holding on to yesterday's number that somebody might have offered them 2 years ago, and what somebody would walk in the door today. I think on the institutional side of things, it's more business-like. There's maybe less emotion, and you're just dealing with numbers. I mean,
Correct.
I'm curious, what you experience on a day-to-day basis.
Yeah, the institutional markets are interesting because they were on the sidelines for a while. And this year was the first year we saw a lot of that money get put out. We look at some of the portfolios that are selling, KKR, Lennar sold their big portfolio, Starwood's making moves, Blackstone is as aggressive as ever. Yeah. I think they're doing $22 billion this year transactions. That market has really helped, though, and to flow confidence in the lower levels. When they see big deals and institutional deals trade, that is a jump starter of where the market is typically going to go. And private capital usually follows those directions. What I saw with private capital in smaller transactions was a lot of all-cash deals. And I'm still seeing a lot of all-cash deals to where people are looking for avenues to make return. And because of that inverted curve that you just mentioned, people are just buying them all cash. And they're buying them for different reasons. If they want to be in the real estate business and they're not in it yet, they want to diversify with some of their stuff on Wall Street and other things. But you're right, it's very difficult to enter this market. There's not a lot of trades typically that happen relative to other locations. But the cost of getting into this, if you look at the price per units of a 10-unit deal, it's a $4 million asset or $3.5 million asset. You take that to Arizona, it's like $1.8 million.
Right, so, where you go to North Carolina or Tennessee or something like that, and it's even less, right? And it's interesting because the cap rates in other parts of the country are a somewhat normal basis. So if interest rates are at, pick a number, 6, you might see a 6 or a 7% cap, and then you might have some rent growth or some upside to get you to an 8% return, which makes sense, right? In California, it's the opposite, which is I'm buying something with a 1 or 2% cash on cash. I'm getting the same 6% debt, and then I have no cash flow.
And it's interesting you brought that up with cap rates being different out of state, because if you remember pre-COVID, everything was like a 3.5 cap. It was very easy to underwrite a deal. It's a 3.5 cap.
Right.
It kind of reminds me of the 90s when it was a 10 cap. Everything was a 10 cap.
Right.
It's nice to now have a market that has differences of risk back into the market. And again, that's a very concerning market when you can buy a deal that's 60s vintage in Arizona for a 3.5 cap, and then a 1980s building in Huntington Beach for a 3.5 cap. So it's nice that there's these things in there. And the other markets, yes, they're very attractive because they do allow for cash and cash return, but you also have a lot of supply situations and issues there. And you look at this year, a lot of those out-of-state markets are having rents coming down, concessions are up, vacancies are up. They're hurting in some of these out-of-state markets. Our markets, relative to all the restrictions, relative to the high cost of entering situation, it still produces great fundamentals. And it still is very resilient and is buoyant, and it allows you to have a very limited risk. It's almost like you're buying a T-bill in a sense, that there's going to have to be a lot of stuff that happens. We looked at COVID, was probably one of the most difficult times in our business since I've been in the business, and you saw how we came out of that better than a lot of other markets, and that's fueling the fire for more capital coming into our locations. And obviously, when you have more interest, more capital, that's going to bring prices up just through competition in the bidding war.
Yeah, and I think, too, the other challenges you've got operating costs still on the rise, whether it's the electric company, the gas company, the water, the trash, all those things up, right? You've got labor still on the uptick. So that relates back to landscaping and pool services and handymen and those types of things. And then you also combine that with the fact that you still have, while inflation is down, the cost of materials still through the roof, right? So these are all, nothing's working in your favor. And so I guess I get back to, why would somebody do it? And the institutional guys, that's what they do, right? It's a vehicle, and there's a return, and there's a hold period, and so they have a model, and it makes sense. When you get down to the family business that's looking to buy something, or the smaller investor, to me, the multifamily is still much better than office building, or the industrial is great. It's flattened now too. The multifamily, I think, will hold long term. You just got to be able to stomach all the challenges, and then you got to be able to manage it either yourself or with somebody else.
Now, I think the reason why multifamily is so attractive to call it the everyday buyer is because they own a home. They may own a second home. So it's familiar, right? And if you buy a 6-unit building, it's like a toe dip into the business. That's like the next step for a lot of these folks, from a fourplex, let's say.
Yeah.
And it's tangible. You can go and you can touch it. They feel safe because there isn't a lot of supply here. So you're going to have your demand. You haven't had a lot of negative rent growth. So yes, there's a lot of operating costs that are challenges, but I think it's really about longer term ownership here. If you look at our sales and how volatile are the velocity of our sales compared to other markets, people hold their buildings substantially longer here than in other markets. And it's because over time it performs better than other vehicles of investment. And people like to be diversified. People who have the type of cash to be able to buy a $4.5 million, $10 million piece of real estate, they have cash to be able to get put to work, and they're usually very successful people in other businesses, and they want some diversification. They don't want all their eggs in one basket, and by doing that and spreading the risk of their investments over different vehicles for their whole entire portfolio, it balances out.
Yeah, I also find that people who are selling a property to buy a bigger property, while that's less prevalent today than it was before, if somebody gave me a stupid number for my property, I guess I'm more inclined to pay somebody else's quasi-stupid number.
If that was going to happen.
Because I was playing with somebody else's money, right?
Right. And if it was going to happen, it would be happening here in this market, right? If you're going to get a big number, it's going to be in Orange County. San Diego is really right there with OC now. And what's interesting is the investors today used to be, I'm just an Orange County guy. I'm just a San Diego guy. Now it's a Southern California. Everyone's moving from different
markets. The footprint
markets.
gets bigger. You look at the desert and you look at Riverside County, those cap rates were never the same as the coast, and now they are, right? And now you have product in Palm Desert at $350,000 a door.
Right.
And for a guy in LA who's paying $500,000 a door plus, it seems cheap. For somebody who bought stuff out there for $100,000 a door, it seems expensive.
Right. Look, the people from LA who have a lot of the restrictions, they're trying to balance those restrictions of a very restrictive area into less restrictive areas. So they are actually one of our most aggressive buyers, are folks either 1031 and exchanging out of LA or have refinanced and want to balance the portfolio with the risk. And you brought up the Inland Empire. I'm a huge fan of the Inland Empire. That's the only area we've had population increase in our market, was in the Inland Empire. And you look at the entrance fee, like we were talking about with Orange County, that is the best place to enter into the real estate market in Southern California. And then lastly, it benefits the same way as an out-of-state market of a tertiary like Arizona or Texas. So it gives you that same type of fundamentals, but with less risk, because you're in California, you get all the benefits of California. So i.e., the Inland Empire, we've probably seen the largest growth of investment and be really open up as a new market for folks that usually weren't there.
Yeah, and I think the only difference in the Inland Empire and the risk is that there's still land, so you can have more product, newer product, nicer product, but the more difficult it is to do business and find good properties in LA or Orange County, people push east. And then secondly, I find that as time goes on, more people who can't afford to live near the coast, who are working near the coast, they'll just go find a job closer to home, and then they'll stay at home. Or they'll get a hybrid work environment and only have to drive a couple of days, and then would live somewhere where it's less expensive, and then they would live further east.
Yeah, and what we saw coming out of COVID was, tenants were looking for more space. They were looking for larger units and more space because they didn't have to go into downtown LA, for instance. You look at markets in San Gabriel Valley, 605 corridor, South Bay, they are producing fundamentals very similar to an Orange County because there's so much demand now because people don't have to live in the urban center. They're choosing to have a better life experience over close proximity to their jobs. So those markets which had a huge exodus into during COVID are sticky. They're staying there now because they like they like the good schools. They like to be able to not have congestion. Crime is less. So there's a huge benefit now to these suburban markets that are now flourishing coming out of COVID, and you're seeing those markets really sell at really big premiums today comparatively to where they were post-COVID.
Yeah, and you look at the product itself, with the amenities, whether it's a patio or a yard area or a garage or electric charger or other things that are important to people today that might not have been available with an older vintage property.
Correct.
They'll pay a little bit of a premium to get it.
Absolutely. And it's going to be interesting where we go from here. I think interest rates, I think most people feel interest rates are going to drop. I'm not the predictor of interest rates, but I think most people feel that where we are right now with the easing from the Fed, that they feel comfortable enough that over the course of the next few years that we'll probably see a little bit better environment of lower rates.
And I had a question. I had a conversation with somebody over the weekend. We were talking about a deal, and they said to me, you could pay my price. Interest rates are going to drop, and you'll get a better deal. And I said, no, because if I buy the property today, I have on a commercial deal, right, unlike your house where you could come back and refinance with no cost or roll the costs into the loan, and you could do it 5 times if you really wanted to. You can't do that on a commercial loan. There's a prepayment penalty, or there's defeasance, or there's a lot of fees, or all the above. And the fallacy, I think, with multifamily that in the average person's head is, if rates come down, you can just refinance it. You could, but there's a cost, right? So if you're the guy who's buying cash and you don't need the loan, you could wait until the interest rates come down. But if you're the guy who needs to put a loan on it to some degree right out the gate, you're stuck with that rate for 5 years or 3 or whatever it is, right?
Yeah, you are, and operating costs are going up. So that's not necessarily true. And I've heard that a lot too, where it's, my NOI doesn't have to change, but interest rates drop and we'll have cap rate compression and I'll sell at a profit. That's a lot of things that have to go right. Yeah. And what I think people are forgetting is insurance costs, water costs, just operating costs. And you got to be able to have your rents be higher than your operating costs to be able to make money and to be able to sell that property or even refinance that property. So I think investors today are looking a little bit more on operating costs and what that looks like in the near future. On the big institutions, though, what we can see, the reason why I feel that rates are going to be lower is because the institutions underwrite what they call an exit cap. And those exit caps were about 50 basis points higher last year than where they're at right now. And that is the assumption that they're going to be selling those deals at those particular cap rates within the next 3 to 5 years.
So it's interesting. And so the perception is, in general, rates will come down, and in general, values should go up.
Right.
Maybe not a direct result of rates, but certainly the more you can get cheaper capital, then you could pay more for if I'm a seller.
Correct.
But I also think on the bigger deals with the larger companies, there is economies of scale, and you're seeing it more with the operating costs, because the only way there's only 2 ways to be able to make more money. I raise the rent, or I got to cut my costs, right? And so if I can only raise the rent so much based on the economy or rent control, I have to go work on the costs. And whether that's technology or people doing more with less or covering more, those are all ways for somebody to be able to do that, which is somewhat difficult to do on a small to middle-sized deal.
Yeah, absolutely. And it's tough to get scale here because you don't have a lot of opportunities to buy like 20, 30 properties that are over 100 units. We just don't have that type of transaction volume. So it's tough to build scale, but it does absolutely help you if you can spread your operating costs over more buildings. But I think when you talk about the increase in operating costs, it's also changing how people are buying today. When you look back, when I got into the business, a lot of those folks that are doing the vintage value-add deals are now in the core plus space because that's where their capital wants them to be. And capital wants to be into deals that are the least restrictive. So the core plus, where you can buy something that's 10 years old and it probably needs a refresh of interiors because it's dated.
But it's not a gut.
It's not a gut. It's like so you're going to be spending less on your renovation costs, but you're getting a bigger rent pop because you're not restricted by any rent control whatsoever. So those are the deals that I would say are the most in demand that you're seeing most of the capital go to. The core deals, people are looking at those as what is the replacement cost? Am I under replacement cost?
Right.
And is this an asset that over time you can't build for what I'm buying it for? And that's a real long-term 10-year hold type of program. And those deals are selling at really low cap rates because they're not so much focused on the cap, they're more focused on replacement costs.
Right.
And then you have the vintage deals, the vintage value add deals, which are looked at differently because of those operating costs. People aren't looking at going in and doing a quick turn. They're buying those deals on existing cash flow that's acceptable for them, with the ability to, over time, in a longer holding pattern, to be able to upgrade those units to hopefully sell those. And just to give some perspective, the typical turn would be like a 3 to 5 year hold. Those new vintage value add players are looking at more of a 5 to 7 year hold.
Got it.
Because they have to.
Because you can't turn it around so quick.
Correct.
And so what are you hearing from, I guess let's break it down, on your side of the equation, from sellers on the larger institutional type properties, and then I guess also to the smaller to middle-sized sellers? What's the motivation for selling? I would think that the larger institutional guys, it's just about the money and the return, and it's time
Correct.
to sell, or I'm paying back the partners, or we're just going to go on to a different deal.
Yeah, it's part of it is redemptions from other product types, like for instance office. So they need to sell because they're having some exposure in the office market. Others, it's because they want to recirculate capital. Others, it's because they're raising funds and they want to show proof in the product of what they've been able to achieve, because that's going to help them raise more capital. Others, it's just a time horizon. So it's a lot of different ways for those guys. Like you said, it's a very unemotional thing. It really comes down to, are they hitting their returns that they need to hit for their partners? And if they go, and if they are, they'll do it. As you get down smaller, it's really what people are trying to achieve. Some smaller groups are trying to get newer. Some are trying to get out from like insurance costs, and they want to get in something that's less restrictive. It's really about on the smaller side of things, what are you trying to achieve? Are you trying to achieve generational wealth? That way you're going into...
Or an event, right? Somebody passed away, partners
Correct.
argue, divorce, those kinds of things
Correct.
that would force a sale.
Correct. And it's really there's a lot of new money coming into the real estate space from other product types like office. Maybe you had a little 14,000 square foot office building and you want to diversify into apartments. Maybe you're coming out of a fourplex and you want to diversify into apartments. I think the interest in multifamily is still pretty big. I don't know if it's Grant Cardone and that's making an influence, but it seems to me like everyone wants to have in their portfolio, if they can afford it, some sort of a multifamily residential element.
Yeah, I think there's still demand, there's still desire, and there's still, relatively speaking, limited amounts of opportunity out there for a decent deal.
Yeah.
Even though I've seen more deals, I gotta tell you, in the last several months than I've seen in a long time. Just a question of the property or the location may be good, and then you got to balance that with the pricing.
Yeah, I think the things that people were waiting to happen have happened. Everybody wanted the Fed to come out and reduce rates. They did that. They wanted there to be less volatility with the T-bills, predominantly the 5 and the 10. That's happening. They wanted it to be below 4. It's below 4. I think it's probably 3.9. It's been hovering around 3.939, 3.839. So all the things that people are waiting on to transact or to buy have now occurred. And again, we've been doing this a long time. I can remember when interest rates were 10%. So for an interest rate to be 5.25 today, that's a really good rate.
Yeah,
that's a really good rate when you think about it. Folks were spoiled with the 3.5s and the 2.5s, but 5 is a really good rate. And if we are in a trajectory, which I feel we're going to be in a slower trajectory down. I call it the reverse bathtub, where I think slowly we're going to have some increases, decreases in rates, but overall, over the course of the next 3 years, we should be on a more downward trend. But it's really about watching the spreads, because the spreads with the debt spreads are really where it's going to make, where you're really going to see it. We could have reductions in the federal funds rate. We could have the 10-year hit lows. But if the bank spreads are still widening,
Correct.
That's going to be a problem, and it's going to offshoot any of the other decreases.
And I think the banks are still somewhat gun shy. While they want, the ones that I've talked to, they want to lend, they want to make deals. They're out trying to do that, but they're also not dropping their pants to be able to do it because there's no money in it.
No, a lot of banks got wiped out, especially on the smaller side with a lot of regional banks and smaller banks. So Chase still is probably the most in demand for smaller deals, I would imagine. For larger transactions, it's Fannie and Freddie. Insurance companies are coming in pretty heavy as well. The debt funds are there. Bridge loans, people aren't really going there yet because they haven't come down low enough. But yeah, there is some limitations. The ones that are lending understand they are the best lender in town, and they're definitely not going to make exceptions to that, they're going to try to make money.
Yeah, no question. And I told you to go quick when we started, and we're running short on time. But
we could do this for hours.
We could. We might not even get anywhere, and we could still do it for hours. Do you think that the election of whoever wins, since we're only a couple of weeks away, does it matter as it relates to the economy here in Southern California and as it trickles down to the real estate markets and the apartments in general? Does it matter?
I think that's a great question. For the first time, we used to have, when we're in this position, we're going to wait till the election's over to go out to market.
Right.
We're not getting that. I think people feel like half the country, no matter who wins, is going to be upset.
Yeah.
I think there is counter to both of them trying to get their agenda across the finish line with Congress. So a lot of the things that are being discussed that they're going to do have zero chances of actually ever getting done. So I think it's just going to have a non-effect. I do think people have preferences and opinions on, and it could depend on the person, have slight benefits or drawbacks, but I think overall in the market, it's not slowing anybody down from making a decision.
I think it's really the interest rates to me. I mean, it's interest rates and it's people's spending habits and people's perception of where the economy is going.
100% agree with that.
More so than something that Washington or Sacramento might come out with.
100% agree with that. The economy, I think, is a little better than people are giving it credit. But the Fed is going to be the one that is making the direction of people's investments.
And then relative to Sacramento, we've had other guests on the show, this push from Sacramento, and it's more than a push, it's a mandate to create affordable housing and to create more housing. I just read an article where Irvine approved to another 50,000 homes in the airport area against the recommendation of the airport commission, against the recommendation of other people. Now, whether those homes get built or not, they have to satisfy Sacramento, so they did it to appease that, because otherwise they get cut off with their money from the state. But at the same time, it is rezoning an industrial complex for mid-rise apartments.
Look at the ADU. I mean,
who's crazy?
Who doesn't know an investor that's doing an ADU unit right now? So that changed. So yes, I mean, I think there's definitely, and that's good for us, right? We need the affordable housing space, again, is a huge space, which is why those fundamentals are so good, which is why people continue to go back to that market, because for those affordable markets, you're not building new construction at a price point that's going to be conducive to that. We are undersupplied as a market here. And I know there's certain areas where there is new construction coming in, but when you look at us as an overall market, we are vastly undersupplied.
Yeah, I agree. And I guess my final question would be, in terms of the longevity of Southern California markets, while it's a big demographic area, how does Southern California compare going forward in the long haul to other parts of the country in terms of sustainability and pricing and value?
Yeah, I don't, outside of maybe, it's tough for me to say that any other market compares to us because we're so unique. You ask any investor across the country, and they want to be here. Now, whether they can effectively get a deal here, that's a different story. But everybody wants to be in Southern California because the lifestyle, the weather, just the basic fundamentals of what we have and the consistency of what we produce year over year. There's no other market that's as consistent as we are. There's no other market that performed as well as we did during COVID at such a long period of time. You go back 10 years, 15 years, there's no market across the country that has produced the consistent returns that we've produced. So I feel that moving into the future, we'll have ups and downs. We'll have more restrictions probably that are going to be tried to be put on the ballot. But at the end of the day, we're still going to be a top 5 market in the country.
Yeah, and look, there is a landlocked to a certain degree, and you still have high density in terms of the demographics, and you still have a lack of affordable and available housing. Those dynamics I don't see changing.
No.
For those out there, I guess the answer or the takeaway from today's show would be, if you're looking at buying multifamily property in Southern California, be careful about the inversion of the cap rate and your interest rate and your operating expenses and what you're doing, but still a solid investment at the end of the day. And certainly if you're investing for the long haul, it's a good place to be.
Absolutely.
So with all of that said, Shane, I want to thank you for coming on the show.
Thank you for having me.
Always a pleasure to chit chat with you, and we can do it some more next time. We'll have you come back and we'll see if any of the prognoses come true and see where the markets are going down the road. But much continued success to you and your family and your business and the company. And thanks for coming and sharing your thoughts.
Thank you for having me.
Yeah. I am Barry Saywitz, president of the Saywitz Company. We'll come back. We'll do it again next week. If it's Tuesday, we're talking real estate. Once again, Evening for Autism, SoCal.com. Go to the website, buy your tickets, check it out. It's for a great cause. We'll see you back here next week on Let's Talk Real Estate.
There you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.